Apple, there's our Apple move into the gap. So we're going to get out of our Apple position. Facebook rallying a little bit here. We'll see what it does when it hits that. So now we would get out of our call options on Apple. We're up $700 from yesterday. I'm going to get out, and the reason that I'll get out, I will explain here in just a minute. I described it to you. So there you go. We made $820 trade from yesterday to today. So the reason for getting out is the fact that the stock is starting to move down into the gap, right? If that gap fills, we could end up giving up most of our profit. And if you notice where the stock is failing today, is very near yesterday's high price. So the order of importance when it comes to the previous day's price, the candlestick. Let's talk about that for just a minute, because this is an important concept, and I think some of you. I'm going to leave that up for right now. I think some of you, even more veteran students, will then benefit from either a review, or you may not have ever seen this. Would Apple be a swing or a trend trade? We got into Apple as a swing trade, but because of the gap up, we and the failure to hold that gap and where it failed, we have exited the position. Okay, yesterday's candlestick, right? This is a bullish candlestick. We're using this as an example. The most important price with regards to today's trading is, relative to yesterday's candlestick, is yesterday's closing price. That is the most important price for us. So a lot of times people get really hung up on the wicks, and it's okay, I get it, but it's not the most important. Number one is the closing price. What's the second most important? The open. Okay, so the second most important price that we watch for areas of support resistance based on the previous day's candlestick is going to be the closing price. And then the wicks, right? And the wicks carries some importance, but it is fairly small. Okay, so the third most important price is the high and low of the previous day. So when we're looking at a candlestick, when we're looking at a chart, we want to be looking at those candlesticks. And so you look at, for example, yesterday with Apple, they traded right up here to this wick, 97.19, turned around and fell from there. We got up to that area, 97.20, a little bit higher than that, and then failed at that point. So important for us to understand that we do need to look at those previous days' areas of support and resistance. We got into Apple yesterday as a potential either value menu trade or a swing trade that we were going to be in for a couple days, 2, 3, 4, 5 days as it moves towards the 50 moving average. But the stock started to fail at its gap. It gapped up this morning, and then it started to pull back into that gap, and that gap now is likely to fill, and that would eat up all of our profit at that point. So at this point, that is a technical reason to exit the trade. It is a known fact that when a stock gaps up and cannot hold those highs, that it is likely to revert, close the gap, and may even trade lower. So if you've got profit there, and guys, this is, you know, admittedly right out of Marquet's DVDs. For those of you that have them, she talks about gap defense.